Let me stop you for real attention, because in roughly 48 hours, a man is going to walk up to a podium in Washington, D.C., open his mouth, and say a handful of sentences. And depending on what those exact words are, silver is either going to rip toward $80 an ounce, or it's going to get dragged back down towards $60. And the truly wild part? 95% of silver investors are not even watching for the right thing. They're watching the wrong number. They're focused on the wrong event. And by the time they figure out what actually happened, the move will already be over. I'm talking about the Federal Reserve's FOMC meeting, this Wednesday, June 17, 2026. And I'm talking about Kevin Warsh, the brand new Fed chair, who has literally never spoken at a press conference in this role before. Welcome to Bullion. My name is Play, and today I'm going to give you the clearest, most complete breakdown of what is coming this Wednesday, what to watch, what it means for silver, and exactly what nobody else is telling you. Let's get into it. Alright, before we talk about Wednesday, let me paint you the full picture of exactly where silver stands right now, because context is everything. As of today, silver is trading around $70 per ounce, and I know some of you are watching that number thinking, okay, that's decent. But here's the thing most people forget. Silver hit an all-time record high of $121.62 per ounce back on January 29, 2026. That was less than 5 months ago, and right now we're sitting at $70. That means silver is still 42% below its all-time high. 42% below its peak in a bull market. And since that high, 3 brutal forces hit silver at almost the same time, and understanding those 3 forces is the key to understanding everything that's about to happen this week. Force number 1 was the SpaceX IPO. The largest initial public offering in the history of U.S. capital markets, $75 billion raised in a single day. Institutional funds across the country spent 2 solid weeks quietly liquidating gold and silver positions to free up cash to participate in that allocation. 2 weeks of steady sell pressure directly hitting precious metals. That force is now done. SpaceX listed. The selling stopped. Force number 2 was the May CPI inflation report, 4.2% annualized. The market read that print as confirmation that Kevin Warsh and the Fed would have to stay aggressive, maybe even raise rates. And when rate hike fears spike, silver gets sold. Hard. That selling took silver from the mid-70s all the way down to a cycle low of $61.59 just days ago. Force number 3 was the June 4th jobs report. 280,000 jobs added. The estimate was 185,000. Blowout number. Strongest print of 2026. That made rate cuts look impossible and pushed the dollar higher, which is like pouring cold water on silver every single time. 3 forces, simultaneously, in under 3 weeks. That's why the crash was so brutal and so fast. But here's what changed this weekend, and this is where things get really interesting. The United States and Iran reached a peace agreement, not a ceasefire, a formal peace deal, confirmed by both sides, confirmed by President Trump, confirmed by Pakistan's Prime Minister. The Strait of Hormuz is back open. The signing ceremony is scheduled for this Friday, June 19th in Switzerland. And when that news broke Monday morning, oil immediately dropped more than 4%. Brent crude fell below $84 a barrel, and silver surged more than 3.5% in a single session, climbing back above $70. Now, why does an Iran peace deal matter for silver? I need you to understand this connection clearly because this is the thread that ties everything together going into Wednesday. Oil drives energy costs. Energy costs drive inflation. Inflation drives the Fed's decision on interest rates. Interest rates drive the dollar. The dollar drives silver prices. Oil falls leads to inflation cools, leads to Fed gets less hawkish, leads to dollar weakens, leads to silver rallies. That's the exact chain reaction that just got triggered, and Wednesday's FOMC meeting is right in the middle of it. Okay, here's where I need to slow down and be very direct with you, because this is the piece that most silver investors are going to completely misunderstand this week. Everyone is talking about the Fed meeting, and almost everyone is focused on one question. Is the Fed going to raise rates or hold rates? And the answer, according to CME FedWatch data, is that there is a 97% probability the Fed holds rates steady at 3.50 to 3.75%. 97%. That is essentially a locked-in certainty. So if the rate decision is already priced in, why does this meeting matter so much? Because the rate decision is only half the story. The other half, the part that is not settled, the part that the market has not priced in, the part that could blow silver in either direction by 10 to 15% this week, is the dot plot. Let me explain what the dot plot is real quick for anyone who's newer to this. 8 times a year, every single member of the Federal Open Market Committee, there are 19 of them, submits their personal projection for where they think interest rates should be at the end of 2026, 2027, and beyond. All those projections get plotted on a chart. That chart is the dot plot, and the median of all those dots, that single number, tells the entire financial world whether the Fed is planning to get more aggressive or more relaxed going forward. If the median dot for the end of 2026 shows even one rate cut still on the table, silver and gold are going to surge instantly, because that means easier money is coming, and easier money historically means higher precious metals prices. If the median dot shows rates on hold, no cuts, no hikes, markets will likely absorb that neutrally, a little dip, then stabilization. And if the median dot signals a rate hike is coming later this year, that is when things could get turbulent, fast. And here's the kicker. This is not just any FOMC meeting. This is Kevin Warsh's first meeting as Fed chair, and in his very first public remarks since being appointed, Warsh himself said, and I'm quoting here, that inflation is not headed in the right direction. That is hawkish language. That is a signal. And the market has been on edge ever since he said it, because nobody knows if Wednesday's press conference is going to sound more of the same, or if the Iran deal and the oil drop have changed his calculus. That uncertainty right there, that is exactly why silver investors need to be locked in on Wednesday. Not for the rate announcement at 2 p.m. Eastern, for that press conference at 2:30 p.m. Eastern, when Warsh steps up to that microphone for the very first time as Fed chair and speaks. Every word matters. Every phrase matters. If he says something like, "We remain vigilant on inflation and stand ready to act if conditions warrant," that's hawkish, sell signal for precious metals. But if he says something like, "We are seeing early signs that inflationary pressures are moderating and we have flexibility in our approach going forward," that is a completely different story. That's a green light for silver. 2 different sentences, one man, one press conference, and silver moves 10% in either direction based on the difference. Are you starting to see why nobody is actually ready for this? Now, regardless of what happens Wednesday, whether Warsh sounds hawkish or dovish, I want to spend a few minutes on the structural story underneath silver right now, because this is the foundation. This is why the big institutional players haven't walked away from this market, even after a 49% correction from the highs. The Silver Institute, the global authority on supply and demand data for this market, published the World Silver Survey 2026 earlier this year. And the headline conclusion was this: the silver market is heading into its 6th consecutive year of structural deficit. 6th consecutive year. That means for 6 straight years, the world has consumed more silver than it has produced. And to fill that gap, approximately 762 million troy ounces have been pulled from above-ground stockpiles since 2021. That's metal that used to sit in vaults and warehouses, and now it's gone. It's been turned into solar panels, electric vehicles, AI server components, medical devices, military electronics. Let me give you a few hard numbers on why this demand is real. Global solar capacity in 2026 is expected to require 120 to 125 million ounces of silver annually just for the panels. Electric vehicle production is projected at 14 to 15 million units globally, contributing 70 to 75 million ounces of industrial silver demand. AI data center hardware requires approximately 3.5 times more silver-coated components than traditional cloud infrastructure. That demand did not exist 5 years ago. Yes, solar manufacturers are thrifting, engineering out some silver per panel as prices rose. That is real, and I'm not going to pretend it isn't. But even with that decline in per-unit silver content, the Silver Institute still projects a deficit of 46.3 million ounces for 2026. A smaller deficit is not a surplus. The drain continues. And supply cannot ride to the rescue here, and this is the part most casual investors completely miss. About 72% of the world's silver is produced as a byproduct of mining copper, lead, and zinc. Miners cannot just flip a switch and produce more silver because prices went up. They produce silver when they're mining what they were already targeting. And building a new primary silver mine from scratch? That takes 7 to 10 years from discovery to first production. The supply response is structurally slow. That's why 5 years of elevated prices haven't solved the deficit. And that's why the structural bull case for silver doesn't change whether the Fed sounds hawkish or dovish on Wednesday. Now let me tell you about something happening right now that mainstream financial media is almost completely ignoring. The COMEX vault. COMEX is the U.S. futures exchange where silver contracts are traded. The registered vault at COMEX, meaning the physical silver that is legally committed to delivery against open futures contracts, currently holds approximately 85 million troy ounces. But the open interest on the July futures contract represents claims on 253 million troy ounces. Do that math. There are roughly 3 paper claims for every single ounce of real physical silver in the vault. And first notice day for the July contract, the day when futures holders can start demanding actual physical delivery, is June 24th. That is 9 days from now. Here's what the track record looks like. In January, 33 million ounces were withdrawn from COMEX in a single week, 26% of the total vault gone in 7 days. In March, 52 million ounces stood for delivery on first notice day against an 86 million ounce registered inventory. The February delivery cycle saw the highest delivery volume in modern COMEX history for a February period. What this tells you is that the people holding long silver futures contracts are increasingly choosing to take delivery of actual physical metal rather than rolling into the next month. They don't want paper anymore. And every time they take delivery, the vault shrinks further. 6 consecutive months below what analysts call the stress threshold. That's not a blip. That is a structural pattern unfolding in slow motion. Let me drop some institutional numbers here because I want you to understand this isn't fringe speculation. Bank of America's head of metals research published a note saying silver can rally above $100 per ounce again in Q4 2026. Their full-year forecast projects silver averaging $85.93 for 2026, and in their most expansive analysis, they laid out a historical bull case where silver reaches $135 to $139 based on the gold-to-silver ratio compressing toward historical extremes. Citi's commodity team raised their silver price target to $100 an ounce back in January, and then raised it again to $150, citing physical market shortages and geopolitical risk. The London Bullion Market Association's January 2026 analyst survey, the most credible institutional poll of professional silver forecasters in the world, returned a median forecast of $79.57 per ounce for silver across 2026. We are at $70 right now. The institutional median says silver is still underpriced by more than 13%, and that's before factoring in any of the new bullish catalysts this week. Now let me give you the gold-to-silver ratio context, because this is how professionals think about silver's relative value. Right now, the gold-to-silver ratio sits at roughly 62 to 63. That means it takes about 62 ounces of silver to buy 1 ounce of gold. The historical long-run average is 65. But in major precious metals bull markets, and we are in one, this ratio has compressed all the way to 32 in 2011 and as low as 14 in 1980. At the current gold price, a ratio of 32 implies silver at approximately $137 per ounce. That's Bank of America's framework, not a blog, not social media, Bank of America. Goldman Sachs has gold at $5,400 by year-end. JP Morgan has it at $6,000. If those gold targets hit, and silver runs harder than gold the way it historically does during precious metals bull cycles, the math on $100 silver isn't speculative, it's arithmetic. Okay, let's bring it all together. Here are the 3 specific scenarios you need to be prepared for on Wednesday, June 17th. Scenario 1, the dovish surprise. The dot plot comes out showing at least 1 rate cut still on the table for 2026. Warsh uses language that acknowledges inflation is moderating, especially in light of oil dropping post-Iran deal. The press conference has a flexible, data-dependent tone. In this scenario, silver pushes aggressively through $72 resistance. We could see $75 to $80 tested within days. Gold moves toward $4,500. The dollar weakens. This is the scenario where the Iran peace deal and the FOMC align perfectly into one giant bullish catalyst for precious metals. This is the scenario most silver investors are hoping for. And right now, it is more plausible today than it was last week because oil has dropped, CPI pressure is easing, and Warsh walks into this meeting with a softer inflation backdrop than he expected. Scenario 2. The neutral hold. The dot plot shows rates on hold. No cuts penciled in, but no additional hikes either. Warsh sounds measured. He acknowledges the Iran deal and oil drop as positive developments, but doesn't commit to any directional shift. He says the Fed is monitoring incoming data. In this scenario, silver dips initially, maybe back towards $67 or $68 as the market processes mild disappointment. But the dip gets bought, because the structural story is intact and the COMEX pressure is building toward June 24th. This is the scenario where disciplined buyers add to positions on the Wednesday dip. Scenario 3. The hawkish shock. The dot plot explicitly signals one or more rate hikes are still planned for later in 2026. Warsh echoes his earlier statement that inflation is not headed in the right direction and doubles down on a restrictive tone. He doesn't acknowledge the Iran deal as a material change to the inflation outlook. In this scenario, silver sees immediate selling pressure back toward the $63 to $65 range. Gold pulls back toward $4,000. The dollar spikes. This is the scenario that would feel like last week all over again, a brutal short-term hit to precious metals. This is also the scenario most people are not prepared for. Not because it's the most likely, it probably isn't given the oil drop, but because they haven't thought through it. And investors who haven't stress-tested this outcome are the ones who panic sell at exactly the wrong time. 3 scenarios: dovish rally, neutral hold and buy, hawkish pullback. You now understand all 3. And that means no matter what happens Wednesday at 2:30 p.m. Eastern, you will not be caught off guard. Let me give you a precise game plan for the next 48 hours. Tonight and tomorrow, Tuesday, June 16th, watch the US dollar index. If the dollar is weakening into the FOMC meeting, that is a bullish tell for precious metals. Watch institutional positioning. Big moves in SLV or PSLV volume before the announcement tell you what smart money is expecting. And watch oil. If Brent crude continues falling toward $80 or below, that is deflationary pressure building in real time, directly softening the case for Warsh to sound hawkish. Wednesday, June 17th, 2 p.m. Eastern. The rate decision drops. Almost certainly a hold. Don't react to this. This is already priced in. Stay calm. Wednesday, June 17th, 2 p.m. to 2:30 p.m. Eastern. This 30-minute window is critical. The dot plot is being read. Traders are parsing the written statement. You will likely see silver move 2 to 3% in the first 10 minutes just based on the dot plot median. Watch where silver goes in this window. That tells you what Wall Street read in the dot plot before Warsh even opens his mouth. Wednesday, June 17th, 2:30 p.m. Eastern. Warsh speaks. Watch for these specific phrases. Hawkish red flag. We remain prepared to act if inflationary pressures persist. Dovish green light. We are seeing conditions that give us flexibility in our policy path. Neutral. We will continue to be data dependent. That press conference, those 45 minutes, will determine silver's direction for the next several weeks. Let me leave you with the bottom line, the Bullion eye perspective on what this all means. Silver at $70 is not expensive. Silver at $70 is 42% below its all-time high set just 5 months ago. The structural deficit is intact. 6 consecutive years of the world consuming more silver than it produces. COMEX vault pressure is building toward June 24th, first notice day. The Iran deal has removed the biggest macro headwind. Oil is falling, inflation is cooling in real time, and Kevin Warsh walks into his first ever Fed press conference in an environment that is meaningfully more favorable for precious metals than it was just 7 days ago. The dot plot on Wednesday will tell the market whether we're heading toward $80 in weeks, or if we need another few months of patience first. But here is the truth that doesn't change regardless of what happens Wednesday. The structural case for silver, the 6-year deficit, the 762 million ounces drawn from above-ground stockpiles, the COMEX vault draining month after month, the industrial demand from solar, EVs, AI, and 5G, none of that changes based on one press conference. Silver's story is not about what Warsh says on Wednesday. Wednesday is just the next chapter. The book has already been written by supply and demand data that Wall Street's biggest banks, Bank of America, Citi, Goldman, JP Morgan, are all pointing to the same conclusion. Silver is significantly underpriced relative to where it's heading. Wednesday is a moment. The bull market is a journey, and the investors who understand the difference between those two things are the ones who make intelligent decisions, not emotional ones. If this breakdown helped you today, if you feel more prepared than you did 20 minutes ago, hit that subscribe button right now and join the Bullion community, because we're going to be live on Wednesday breaking down the FOMC decision in real time. The dot plot, the press conference, the silver reaction, we're going to decode all of it for you the moment it happens. Drop a comment below right now. What is your silver price target by December 2026? I read every single comment. Let me know where you think this is going, because ready or not, Wednesday is coming. The question is whether you're watching the right thing when it hits. This is Bullion. Stay sharp. We'll see you Wednesday.